So, if you're running a business that operates globally, you're constantly dealing with a moving target, foreign currency. You might be buying in euros, selling in yen, but your books are in dollars. And every single day, those exchange rates shift. And each tiny little movement can create unexpected profits or, some pretty painful losses. The big question is, how on earth do you account for it all?
Let's make this really concrete. Imagine your US-based company buys a bunch of goods from a supplier over in Sweden. The price is in Swedish kroner, but by the time you actually pay that invoice a month later, the exchange rate has moved. Suddenly, that transaction costs you more, or maybe less, in dollars than you first put on your books. So what do you do with that difference? Well, that's exactly the puzzle we're going to solve today.
Okay, so let's dive right into the heart of it. Before we can even learn the rules, we first have to appreciate why this is such a game. Why is this whole currency fluctuation thing such a persistent headache for accountants and CFOs? I love this analogy. Just think about it. The very value you're trying to measure is always shifting. Luckily for us, there's a rule book for this game. It's called International Accounting Standard 21, or IAS 21 for short, and it gives us the official framework for handling these constantly moving goalposts. All right, to navigate IAS 21, you're going to need the right tools. So let's build our accounting toolkit. We're going to go over a few key terms that are absolutely essential for understanding how to handle pretty much any foreign currency transaction that comes your way. So here's the official line. At its core, IAS 21 is just about setting the ground rules. Its entire purpose is to make sure that when a company translates all its foreign currency activities, it does it in a way that's logical, consistent, and frankly easy for people to understand. First up, two really critical ideas: functional and presentation currency. Your functional currency is the main currency of the economic environment where your company operates. Think of it as the currency you mainly use to make and spend cash. The presentation currency, on the other hand, is just the currency you use to present your financial statements. Now, they can be the same, but they definitely don't have to be. Next in our toolkit is a distinction that is, and I'm not kidding here, absolutely critical. It's the difference between monetary and non-monetary items. Monetary items are things that are easily converted into a known amount of cash, think receivables or payables. Non-monetary items are things like your inventory or a piece of equipment. You have to pay close attention to this one because this single distinction is the key to everything that comes next. It dictates exactly how we treat these items at the year end. And finally, let's quickly cover our key exchange rates. The historic rate is simple. It's the rate on the exact day a transaction happened. The closing rate is the rate at the end of your financial year, the reporting date. And the average rate is, well, it's just an average for the period. For what we're doing today, we're mostly going to focus on the historic and closing rates. All right, toolkit is assembled. Let's get our hands dirty and put these concepts into action. We're going to follow the journey of a simple foreign currency transaction, right from the moment it happens to the moment it's all paid off. For a transaction that starts and settles all within the same accounting period, the process is pretty straightforward. First, you record the transaction using the exchange rate on that day. That's our historic rate. Second, when you settle the bill, you use the rate on the day you make the payment. And third, because those two rates are almost never the same, there's going to be a difference. That difference gets posted as an exchange gain or loss, and it goes straight to your income statement. Let's make this real with an example. A U.S. company buys goods for 54,000 units of some foreign currency. We'll just call them crummets for fun. Now here are the key details. The purchase is on April 1st, but the payment isn't due until May 31st. And crucially, the exchange rates are different on those 2 days. So how do we record this? Well, on April 1st, we translate the purchase at the historic rate. That's 54,000 crummets divided by 1.80, which gives us $30,000. We record that as a purchase and a payable. Simple. But 2 months later, on May 31st, it's time to pay the bill. The rate has now changed to 1.75. So those 54,000 crummets are actually going to cost us $30,857 to settle. And there it is, right there. The difference, $857. The company had to spend almost $900 more than it originally recorded just because the currency value shifted. And that's not some theoretical number on a spreadsheet. It's a real foreign exchange loss that directly cuts into the company's profit. So that was the simple version. But what happens when a transaction straddles the end of a financial year? This is where things get a lot more interesting, creating what I like to call the year-end wrinkle. I mean, this happens all the time, right? You've bought the goods, you've recorded the payable on your books, but the year ends before you've actually paid the invoice.
So, what do you do with that outstanding liability just sitting there on your balance sheet?
Okay, here's our next scenario. On January 1st, a U.S. company buys goods for 35,000 dinars. The critical fact here is that their financial year ends on March 31st, but the bill is still unpaid. And, of course, the exchange rate on the purchase date is different from the rate at the year end.
And here's where that toolkit we built becomes so important. The initial transaction gets recorded at the historic rate, which works out to $20,000. But because the payable is a monetary item, IAS 21 tells us we must retranslate it at the year end using the closing rate. At that new rate, the payable is now only worth $18,421. The result? A gain of $1,579. And this is the part that blows people's minds. No cash has changed hands yet. This is a paper gain. But according to IAS 21, it is very, very real. The company actually recognizes this gain on its income statement for the year simply because the exchange rate moved in its favor. So this brings us to this single most important rule you need to remember for handling these year-end transactions. Monetary items, things like cash, receivables, and payables, they must be retranslated using the closing rate. Non-monetary items, like your inventory or equipment, they just stay at the historic rate you first recorded them at. That's it. That's the core principle.
Woo, we have covered a ton of ground, haven't we? From definitions to some pretty tricky practical examples. So let's just take a moment to zoom out and recap this entire process with a really simple visual guide. This flowchart pulls it all together so neatly. Every foreign currency transaction starts with an initial treatment. You record it at the historic rate. If it's a settled transaction, the difference when you pay is a gain or a loss. If it's an unsettled transaction at the year end, you just have to ask one question. Is it monetary or non-monetary? If it's monetary, retranslate it at the closing rate. If it's non-monetary, you leave it alone at the historic rate. It's really as simple as that.
So, there you have it. We've walked through the rules of the game. You've now got the toolkit to account for those constantly moving goalposts. But this all leads to a much bigger, more strategic question. Knowing that these currency fluctuations create real gains and real losses, how can a business go beyond just accounting for them and actually start to manage and mitigate that financial risk? Now that's the crucial next step, from accounting to strategy.